Hello and welcome to Financial JCL. Today we're going to review Tyson Foods. We're going to review them under the 5 areas that you can see on the screen now. We're going to get straight in and talk about the chance of failure. Now, with the chance of failure, first of all, they've been doing well on their debt, and the debt to equity ratio has been improving in recent years, and it's below my target level. Most recent accounts, it's around about 40%, which is pretty low, so that's unlikely to fail on that count. And the dividend is very affordable with a payout ratio below 30%. Sector is also quite low risk. It's food. There's going to be a relatively consistent demand for the sector in general, and in fact, probably increasing as the world population increases. And they have a reasonable interest cover in terms of ability to cover their interest payments. Theirs is around 10x. I'm looking for sort of 14 to 16 times, but 10 is not too bad. Also, their current ratio is close to 2 than it is to 1. So therefore, their ability to pay their short-term day-to-day bills is solid. So my assessment here, and this is only my personal assessment, not advice to you, is that it is unlikely to fail as a company. Shout out before we move on. Thank you very much to these two fine gentlemen who are part of the Financial JCL investing community. In particular, thanks for contributing on the Discord server. If you'd like to join these two very fine gentlemen, please check out the link below to the Patreon, which will also get you access to the Discord server, where we regularly discuss investing ideas, such as the subject of this video, which came up on the Discord server. So that takes me to my second point of review here, which is the quality of the company. Now, I've got criteria for what I'd call a quality stock. I'm not sure this actually fits the quality stock bucket because we're looking at high gross margins, high operating margins, high cash flows, but this might well fit into my dividend part of my portfolio. That's worth noting their return on capital is consistently in that 10 to 15% range, which is okay. The gross margin is okay as well. It's never going to be high in this sector. Again, that gross margin is generally 10 to 14%. The operating margins are pretty low. Again, not surprising given the sector. Those operating margins for the last 10 years have all been in single-digit figures, just below 10%. However, they are consistently profitable, and there is good book value growth. They grow the net asset value of the company historically in the last 10 years by around about 11% a year. That's pretty impressive. And you could say book value to an extent is a proxy for the intrinsic value of a company. However, recent earnings, the last 4 sets of earnings, I believe, certainly the last 3 sets, they've actually missed on the analyst estimate. Not by much, but they have missed. So the third category, sort of the general other factors. Now, the industry is a suitable industry, like buying a company, food industry, buying part of a company. It isn't a problem. It's been around for a long time, not subject to particular technological innovation or fads to a certain degree. Also, there is a dividend that is over 3%. Payout ratio is in the high 20s. The payout ratio in the most recent figures is 27%. And in the last 10 years, that payout ratio has never been above 30%. So there's always room to grow the dividend. And it's at 3.2% at the moment. So you can easily see that dividend being 5%, perhaps 6%. I've been doing a little bit of share buybacks, but not excessively. And growth is predicted. Simply Wall Street's analyst grouping is saying over 12% a year growth. Yahoo Finance is saying 7.5%. And of course, that historic book value is growing at 11.8%. So I'm going to take the sort of the lower of those and go with 7.5% to be a bit more risk averse. Certainly, the general consensus is historically they've grown and they're expecting growth in earnings in the future. Now, there is quite a lot of capex, so a lot of the cash flow generated from operations doesn't get translated to free cash flow because there's a moderately high capital expenditure. That's a negative point in converting cash generated to what Warren Buffett calls the owner's earnings, i.e. the free cash flow. But overall, the other factors look pretty good. We now move to the sort of valuation part. There has been book value growth and dividend growth is possible, as we said. So these play into that valuation. Now, I'm not going to use free cash flow here. First of all, you could say, well, the market price is very similar to the book value of the company. I think the book value is around about 5, market price is around about 60. So they're pretty close, but there's no margin of safety there, of course. Take into account the dividend, take into account the historic book value growth, project that forward, and apply a discount rate. The estimated return at the current price is actually around about 12%, whether you look at it for 5 or 10 years. Now, my portfolio for my sort of stretch target, I want 10% a year. The fact that the estimated return is 12% gives me almost like 2% as always margin of safety, which isn't a huge amount, but it might be enough, not likely to fail. All we need, it could be excess return, assuming I've got my numbers right, that is. So my decision for my portfolio, and I stress this is just for my individual circumstances, first of all, it does fit the structure of my portfolio. It would hit dividend pot because 3.2% with room to grow and some capital appreciation possibility. It does hit that required rate of return. I'm estimating 12%. And I've got quite a high cash position, still around about 20%. That's just doing nothing. The best way to win in the market in the long term is to be close to fully invested as possible. And I am conscious of, I think I've mentioned it several times, I've got too many positions in the portfolio. That makes me reluctant to start a position in this company. What I need to do is review it against some of my existing dividend of other stocks, and then just to see whether or not this is suitable. So that is the summary, and I'm thinking about looking at this company against Walgreens and against Ruger & Co. in that dividend pot. So I'm not going to buy it yet. I need to sell one before I can buy. I need to be disciplined on the portfolio getting too big again in terms of number of holdings. Do you hold Tyson Foods, or are you thinking about buying Tyson Foods after having seen this video? Please comment below. Otherwise, check out my portfolio. You don't want to miss it. Links coming on screen now. Check it out. Check it out, and I'll see you on the next